Welcome back to Investing Talk Podcast. Today we're getting into a company that's trying to, well, literally power our future. Enovix. This exploration is all about cutting through the complexity surrounding their recent developments, understanding their financial landscape, and ultimately figuring out what it all means for you.
That's right. Enovix is at a really interesting point in the advanced battery technology sector. Our mission today is to really understand its journey. How a company with pretty groundbreaking innovation navigates the complex, sometimes brutal realities of commercialization. We'll look at how far they've actually come and what challenges still lie ahead.
Absolutely. And as we start this exploration, we do invite you to subscribe, like this particular show, maybe leave a comment with your thoughts. And if you find value in what we do, maybe consider buying us a coffee to support future explorations. Every little bit helps us keep bringing you these in-depth looks. Okay, so let's unpack this innovation a bit. When we talk about Enovix, what is it exactly they're building? And why is it getting so much attention? What's the core idea here?
Well, Enovix specializes in advanced lithium-ion batteries, but what really sets them apart is their proprietary silicon anode technology. Think of it like this. Silicon, theoretically, can store maybe 10 times more energy than the graphite used in most batteries today. So that means potentially a lot more power packed into a much smaller space.
Okay, 10 times. That's a huge number.
It is. But the real trick, and this is where Enovix claims its breakthrough, is making that silicon stable. Silicon likes to swell up and crack when charged and discharged. They believe their architecture solves this. This isn't just a small improvement. It's a fundamental design difference aimed at much higher energy density and, importantly, improved safety compared to conventional cells.
Right, more power, smaller size, safer. That sounds like the holy grail for, well, almost every electronic device, doesn't it? Especially where space and safety are really critical. What specific areas are they targeting?
Precisely. Their main applications cover a pretty wide range. Consumer electronics, like smartphones. In fact, they've shipped early engineering samples to major smartphone makers already. Then you have wearables, IoT devices, extended reality XR, and even defense applications where custom high-performance packs are needed. They're positioning themselves as an innovator, a challenger to the big guys like Panasonic and LG Energy Solution, really differentiating through that patented cell design.
That distinction does sound key. So they got this impressive tech advantage on paper. We often see this, don't we? The real test for these deep tech companies isn't just the invention, it's the execution, it's scaling up. What concrete steps have they taken recently? What are the big operational wins or maybe corporate events that show they're moving forward?
Yeah, they've definitely been busy. A key corporate event was their annual stockholders meeting just recently, June 17th. They had about 67.5% voting power represented. Stockholders approved the directors, executive compensation. Shows a stable governance structure. Operationally, the big focus has been their Fab 2 facility in Malaysia. It just received ISO 9001.2015 certification.
The quality standard, that's important.
Very important. It came after a successful audit, and it's a big deal for quality assurance, especially in high-volume manufacturing. It's like a global stamp of approval. And maybe even more critical, site acceptance testing SAT for mass production there is now complete. That means the equipment, the systems, they're all verified and ready basically to start churning out batteries at scale. Mass production is still on track for late 2025.
ISO certification, SAT completion. Those definitely signal they're serious about quality and scale. But, we've seen other companies get certified and still hit roadblocks ramping up actual production.
How confident are people that these milestones really mean mass production is on schedule? And what about customers? Are they seeing real traction there?
Those are fair points. Analysts seem generally encouraged because these are concrete, third-party validated steps. It reduces some uncertainty. And yes, on the customer front, there's tangible traction. Late last year, early this year, they shipped those engineering samples to leading smartphone OEMs. Plus, they secured a significant prepaid purchase order for smart eyewear batteries. So it's not just talk, it's actual customer commitment.
Prepaid orders are always a good sign.
They are. And on the corporate side, they brought in Ryan Benton as CFO back in April. That kind of move usually signals a sharpened focus on financial discipline as they gear up for that production ramp and managing those orders. Okay, so things are happening. How did the market take all this recent activity? Did these milestones actually, move the stock price, or was it maybe already expected?
The market did react positively. Around June 16th and 17th, the stock climbed about 8.7%. It closed near $8.94, up from around $8.22. However, it's worth pointing out the trading volume during those couple of days was actually quite low compared to its average. So yes, a positive move, but maybe not reflecting huge, widespread market excitement just yet. More like positive sentiment, perhaps mixed with a bit of a wait and see from the bigger investors.
Right, a positive blip, but maybe not a massive surge. That gives us a sense of the operational side. Now, let's try to connect this to the financials. How does the balance sheet look with all this going on? Are these operational steps starting to translate into, well, financial health? Or is it still very much that pre-profit phase we see with these kinds of tech innovators?
It's definitely the critical question, and honestly, it's a mixed picture. They've shown some impressive revenue growth, no doubt about that. Q1 2025 revenue was $5.1 million, which met or slightly beat their guidance. They had a record Q4 in 2024 with $9.7 million, and the full year 2024 revenue hit $23.1 million. That's up over 200% year over year.
Wow, 200% growth is substantial.
It is. And a really significant financial milestone they hit was their first positive gross margin, 11% in Q4 2024. Now, 11% might not sound huge, but for a company like this, just starting to scale complex manufacturing, it's critical. It proves they can actually build these advanced batteries for less than the direct cost to sell them. That's a hurdle many startups don't clear.
Okay, that positive gross margin, even if small, is a really important signal. It shows the basic unit economics can work, but is it enough? Is it enough to cover everything else, R&D, building factories, all that overhead, or are they still burning cash overall?
Unfortunately, not yet. That's the classic challenge, isn't it? Even with improving margins per battery, the sheer cost of R&D and building facilities like Fab 2 is immense. So yes, they're still very much in that cash burn phase. We're looking at significant net losses. For instance, Q1 2025 had a GAAP net loss of $23.5 million. Q4 2024 was even higher, a $37.5 million loss. And just quickly, GAAP is the standard accounting, but even looking at non-GAAP figures, which adjust for some items, Q1 2025 still had a non-GAAP operating loss of $29.4 million and an adjusted EBITDA loss of $22.2 million.
So deep in the red.
Deep in the red. The consensus forecast for their earnings per share for this whole fiscal year, 2025, is still negative, around negative $0.92. It just underlines that they remain unprofitable. And that's why metrics like the PE ratio or return on equity, they don't really tell you much right now. They only make sense for profitable companies. A negative EPS just confirms they're investing heavily in growth, not yet earning profits.
Right, standard metrics don't apply yet. So given these losses, what about their cash? How much runway do they have, especially with all of the spending on Fab 2?
They ended the first quarter of 2025 with what they term sufficient liquidity. This was helped significantly by a $100 million equity raise they did late in 2024. Management believes that cash should last them until at least September 2025. However, there's sort of an implicit understanding that if that revenue ramp from Fab 2 doesn't pick up speed quickly enough, they might need more capital later this year or next.
Okay, so the clock is ticking a bit on that cash.
It is. This ongoing operating loss and potential need for more funding, that's definitely a red flag for investors to watch closely. They do have long-term debt, around $169 million, mostly in convertible notes. These are basically loans that can turn into stock later. The good news there is they carry pretty favorable interest rates, mostly under 6%. And another positive point is that capital expenditures, spending on buildings and equipment, should drop significantly now that the major build-outs are nearing completion. That should help slow the cash burn rate.
Less spending on building, hopefully more revenue coming in. That makes sense.
It's kind of like building a factory. You spend a ton up front, and you don't make money until the production lines are running full tilt. Enovix is right at that transition point.
A good analogy. Okay, we've covered the tech, the operations, the finances. How is the broader market, the analyst community, processing all this? Are they bullish or are they skeptical about those losses?
Analyst sentiment is overall still quite positive, which is interesting given the losses. Out of 11 analysts tracked recently, 8 have them rated as buy or overweight. Only 3 are at hold. And the consensus price target is pretty ambitious, hovering around $17.27 per share. That's almost double where it is now.
$17. That's optimistic.
It reflects a strong belief in the technology's potential and the validation from those customer deals. However, you do have to note that some firms have actually trimmed their targets a bit since earlier in the year. They might cite broader economic headwinds affecting the tech sector, or maybe just think the production ramp-up might be a touch slower than first hoped. So even the optimism is grounded in reality.
Okay, mostly positive from the pros. with some caveats. What about the buzz online, social media places like X or Reddit? Does it mirror the analysts, or is it a different story?
Social media sentiment is maybe best described as cautiously optimistic. You see excitement about the operational wins, like the ISO certification. People see that as real progress. But alongside that, there's definitely clear concern about the continuing losses. A lot of users are basically saying, show me the scaled production, show me the revenue before they get fully convinced. And of course, with social media, you always have to be careful about unverified rumors or just overly emotional takes. Always best to check against official company statements.
Sound advice. So the general feeling is progress, but waiting for the financial proof. You mentioned that stock uptick earlier. What specifically triggered that? Was it mostly those operational milestones like ISO and SAT?
It seems primarily driven by the growing confidence that Fab 2 really is on track for mass production later this year. That's the big catalyst everyone's watching. Achieving those specific milestones, especially the ISO certification, definitely helped solidify that confidence. And as we mentioned, that continued backing from most analysts, even with slightly adjusted targets, provides a sort of baseline support for the stock price. It was a mix of tangible progress and professional endorsement.
Makes sense. Looking ahead then, beyond these recent events, what are the biggest risks facing Enovix as they try to make this leap to mass production?
The number one risk is execution risk, plain and simple. If those mass production timelines slip, if there are quality issues at scale, or if customer adoption doesn't happen as quickly as they hope, then those net losses will continue, and the need for more cash could become urgent. That's the big one. Then there are macroeconomic factors. Higher interest rates could make future funding more expensive, or a slowdown could impact customer spending on the electronics they power. And finally, it's just a ferociously competitive field. Battery tech moves fast. They need to keep innovating while also delivering reliably.
Execution, funding, competition. Pretty standard for this kind of venture, but very real risks. Okay, let's flip that. What's the big opportunity? What's the potential reward if they do navigate these risks successfully, if they hit their production targets?
The opportunity is frankly enormous. Landing those major OEM customers early is huge. It gives them a clear path to potentially rapid scaling once Fab 2 is fully operational later this year. That ISO certification isn't just a badge. It helps open doors to other big quality-conscious customers who need that proof of reliable manufacturing. If they successfully make this transition from R&D and pilot lines to genuine high-volume manufacturing, the market for their kind of battery compact, powerful, safe, especially for premium devices, is massive and still growing fast.
Right. So putting it all together, what does this mean for you, the listener, trying to evaluate a company like Enovix? How does it stack up against other next-gen battery hopefuls? How should you weigh the potential against those financial hurdles?
Well, if you look at the broader landscape, you've got companies like QuantumScape focusing on solid state, Amprius Technologies also working with silicon anodes. There's a lot happening. What seems to distinguish Enovix right now is having those secured commercial agreements with top-tier customers already in hand, and their, very visible progress towards actual product launches with Fab 2. This puts them arguably a step ahead of many peers still deeper in the R&D or pilot stages.
So they seem closer to actual commercial reality, not just lab results.
That seems to be the case. And it's why you hear analysts talking about 2025 potentially being an inflection year for Enovix. The expectation is built around seeing real revenue from serialized production by the end of this year, flowing from those customer relationships. But again, that common hold recommendation you see reflects the balance. There's clearly compelling long-term potential. The tech seems validated. They have the partnerships. Commercialization is imminent. But you have to temper that with the near-term reality. The ongoing losses, the cash burn, the likely need for more funding until large-scale shipments prove they can reach sustainable profitability. It's that tension. Enovix really is a fascinating case study, isn't it? You have this cutting-edge technology, but it's facing these huge financial and operational challenges of bringing in something truly new to mass production. So the question for you, the listener, is really, how do you personally weigh that future technological potential against the very real financial hurdles they face right now in the near term?
That really is the core tension, isn't it? The promise of the breakthrough versus the hard realities of scaling and profitability. For you listening, what factors would tip the balance? Is it the tech itself? The customer wins? Or do you need to see that bottom line turn black first? Definitely something to think about as we wrap up this exploration.